Hi, this is Eric Tenbroeck, and the purpose of this very short PowerPoint presentation is to show you how to get the American Opportunity Tax Credit for the qualified tuition and related expenses of higher education. So we found in our practice you may be losing dollars on a tax credit available to the U.S. taxpayer. The problem? No education credit for you. You have children in college, but you're phased out of the tax credit. You may be missing out on up to $2,500 a year for the tax credit, but we found that there is a fix, and the fix is for the parents to forego taking the child as an exemption or a dependent on their return. The credit phases out for joint filers with adjusted gross income between $160,000 and $180,000, which happens quite often when mom and dad both work. Also, what happens or occurs, the qualified higher education expenses are entered on mom and dad's return, but the credit's phased out and the opportunity is lost. Also problematic for years after 2012, the exemption amount of $3,900 is phased out for married taxpayers with a high AGI. Therefore, some parents are getting locked out of the higher education tax credit and also not getting the dependent. The fix. Parents elect not to claim the child as a dependent. The parents forego claiming the child as a dependent. Under the IRS regulations, the student is now eligible to claim the American Opportunity Tax Credit on his or her own federal tax return. However, the student can now only use the qualified expenses to claim the credit. If someone other than the taxpayer pays the tuition on behalf of the student is still treated as if he or she made the payments to the educational institution. Notes and caveats. It's a bit of a nuisance to calculate. You first must determine the tax liability with the parents claiming the student and attempting to take the education credit. Then what happens is you remove the student from the parent's return and have the student take the education credit. It's been our experience that the student gets at least some portion of the credit. So we found it's beneficial in many cases for the parents to forego the dependency exemption and have the student take the expenses on his or her own. The student child in many cases will not be entitled to claim an exemption for him or herself. Okay, so per the IRS publication number 17, if a parent can claim an exemption for a dependent, that dependent cannot claim a personal exemption on his or her own tax return. Continued with the notes and caveats, per IRS publication number 17, the standard deduction for an individual who can be claimed as a dependent on another person's tax return is generally limited to the greater of $1,000 or the individual's earned income for the year plus $350, but not more than the regular standard deduction of $6,100. Continued with the notes and caveats is that if the student is covered under mom and dad's health insurance policy, please check the plan provisions to see if claiming the child or student as a dependent on the parent's tax return is a condition of coverage. So here's the overview of the American Opportunity Credit. Comes straight from the IRS publication. The key here, or one of the key points I'd like to point out, is that the credit is up to $2,500 per eligible student, but 40% can be refundable. In other words, $1,000, 40% of $2,500 can be a refundable credit, which means that the child does not have to have a tax liability equaling $1,000. They'll get it as long as they qualify for the credit and they have the qualified expenses. They still can get almost a guaranteed $1,000. Okay, to conclude our presentation, we have to include the IRS disclosure. Sorry, we have to. So this is the standard IRS circular 230, the disclosure. Thank you. I hope you find this helpful. Please ping us back on an email if you'd like any further information. Thank you.